Hello everyone and welcome to my channel. I am super excited about today's video. Today's video is a 1-hour full free course covering everything you need to know before you begin investing your hard-earned money into the stock market. We're going to be taking you from beginner to expert. We are going to be learning so much, some of which being why investing is important, what the stock market even is, how to make money in the market, asset allocation and risk management. We're going to be talking different investment options such as stocks, mutual funds, ETFs, and REITs. We're going to be learning how to do our own due diligence and how to interpret the numbers. We're going to be talking different investment strategies and how to buy your very first stock. And then finally, I'm going to offer up some of the very best advice I can give in terms of investing. We're going to be doing all of this and so much more. I'm so excited to present this information for you. As an added bonus, I do have this full presentation linked down in the description below. Also, I have all the timestamps, so if you're looking for something specific, it should be super easy for you to find. Also, if you're watching this video for a second or third time because you're coming back and want to refresh some of the material, it should be easy for you to find. Okay, well, thank you. Please like and subscribe to my channel. Really appreciate you guys, and let's dive into the presentation. Okay, firstly, beginner basics. In this section, we're going to address some common questions and common misconceptions beginners have. Firstly, why do we need to learn about investing? Why is learning about investing important? Well, one, it allows you to let your money work for you. See, the thing is, the stock market is actually the #1 tool in all of human history for people to build wealth. The stock market has offered a 10% annualized return for the past century. That means if you just took $100 and put it into the stock market and waited 100 years, that $100 would become $1.3 million. Now that's the power of the stock market. Another reason why learning about investing is important is because cash is trash. Saving doesn't beat the rate of inflation. There's this concept, there's this idea called time value of money, or TVM for short. And the time value of money simply states that cash you have today is worth more today than it will be in the future. And that's because inflation eats at your cash's buying power. So remember, cash is trash. And a third reason why learning about investing is important is because of the power of compound interest, earning interest off of your interest. Einstein even said that compound interest is the most powerful force in the universe, and he who understands it earns it, and he who doesn't pays it. Here, I want to move over to my iPad for a moment and give you a little example of what compound interest is in case you're still confused. What compound interest is earning interest off your interest. So if you have a principal amount of $100 and then after 1 year with a 10% return, this $100 becomes $110, right? And if that same process happens, you wait another year and you have another 10% return, which is what the stock market's done, this $100 now becomes $121. All right, that's this earning this extra dollar. Where did that dollar come from? It came from earning interest off of the interest you had earned the year prior. Okay, and that is where all the power comes from. I know this one doesn't seem like a lot, but over the course of time, it adds up to be just a ton of money. A piece of advice for you, or a piece of knowledge: if you can save $100 a month from age 20 to age 30, then by the time you retire, the money you've saved would be worth over $1 million. So you can start small. You can just save $100 a month, and after 10 years and the power of compound interest, once you reach retirement, that savings will accrue to a value over $1 million. Think about that. It's a very powerful idea. Let's go back to the presentation. All right, so to answer some common questions, firstly, this very basic question: what is the stock market? Okay, the stock market is simply the marketplace in which people go to buy or sell stocks. Now, normal trading hours for the New York Stock Exchange is from 9:30 a.m. to 4 p.m. Eastern Time on weekdays. The stock market is closed on weekends, and it is not 24/7 like crypto markets are. Another common question, or something we need to talk about, what is a stock and what is a share? Okay, what are these terms you're going to hear a lot? Well, a stock is a generic term referring to ownership interest in a publicly owned company, and a share is the smallest denomination of a company's stock. Now, what does that mean? Let's move back over to my iPad, and we will, let me give you a little visual for it. So let's say we have a share. This rectangle represents the stock of a company. Now we can take this stock of the company and we can divide it up into many pieces. Okay? In these pieces, each single individual piece is a share. Now, stock represents ownership in a company. So how do you figure out what percent of that company you own? Well, you take the number of shares that you own and divide it by the total number of shares that the company has issued. So you take what you own and divide it by the total, and that tells you the percent of the company you own. And you can own very small percentages, and most likely that's how it is. So that's the difference between stock and share. What is a bull market? What is a bear market? Okay, whenever you begin investing, you start watching all these financiers on YouTube, or maybe you're watching CNBC, you're going to hear bear market and bull market. What does this mean? Okay, bull market is when the stock market as a whole is trending upward, and bear market is just the opposite. It's when the market's trending downward. Also, you can be bullish on a stock or bearish on a stock. If you're bullish on a stock, that means you really believe in it. You think it's going to go up and up. So that's what those words mean. So here, why do companies issue stock? This is important. Stocks are issued by companies so that those companies can raise money in order to grow the business or undertake new projects. If the company is wanting to go into something new, if they want to pursue a different revenue stream, then they will sell shares and put them on the public market, and people like you and I or institutions can then buy those shares. Do I owe money if my stock goes down? All right, this is a question I've gotten before from some people. And very simply, while the value of your investment will decrease, you do not owe any money. Okay? And again, let's go back to the iPad for a moment. Now, let's say we purchase a stock. We purchase a share. So little Timmy here, he has his $100 bill, and he's going to reach up and take that share. So he spends his $100 and now has a share of his favorite company. The value of this share could go one of two ways. It could go up or down, right? It could become $120, or it could go down and become $80. However, regardless of price movement, little Timmy still just owns his single share. He still just owns his one share. And he doesn't gain or lose any value until he chooses to sell. If he sells up here, which is what I hope he does, and gets a $20 profit, then fantastic. He'll pay $20 or he'll pay a capital gains tax on his $20. Or if he loses $20 and sells for $80, then he can put that as a capital loss and take that against his gains. All right. Who buys the stocks I sell? Mentioned this a little bit just prior, but Again, the stock market is just that, a marketplace, and institutions, market specialists, corporate traders, or individual traders can buy your stock on the stock market. Can you lose all your money in stocks? Yes, a stock can lose its entire value. If the company you invest in goes bankrupt and goes to zero, your investment can also go to zero. How do you make money in stocks? Well, okay, there's two primary ways to make money in stocks. The first way is to sell your shares for a profit, and the second way is that the company pays you, a shareholder, a dividend. And a dividend is a distribution of the company's profits paid out to the shareholders. And so in other words, whenever a company makes a profit, they can do one of two things. They can take that profit and roll it over into future growth opportunities, or they could take and all companies do that. But some companies, instead of doing that with all of their profit, they take a piece of their profit and they pay it out to their shareholders in a form of a dividend. So different companies have different strategies, and those are the two ways that you can make money from your stocks. Is $100 worth investing? Well, you already know my answer to this, but yes, whether it's $1 or $1,000, beginning and making a habit of investing is the most important thing. And the fact that you are being proactive and watching this video and learning, good on you. Pat yourself on the back. Yes, whatever the amount is, it's totally worth it to begin. Digging deeper. Okay, again, in this section, this section's kind of two parts. The first part, we're going to be talking different categories for stock, and the second section, we're going to be talking the different investment options, the individual stock, ETF, REITs, and the pros and cons and the differences between them. So firstly, preferred stock versus common stock. So it's very important to realize whenever you are purchasing a stock, you are 99% of the time going to be purchasing common stock. Common stock is what you buy whenever you're on WEBULL or Robinhood or Public. And primary stock, it's mostly reserved for institutional buyers, they get certain tax benefits from them. Individuals can buy preferred stock, but 99% of the time, individual investors are purchasing common stock. However, what's the difference between the two? Well, preferred stock has no voting rights, there's limited upside, they receive a higher dividend, and they have a greater likelihood of being repaid if the company goes bankrupt. For common stockholders, they have voting rights, there's unlimited upside. See, for common stockholders, the share price can go up and up and up forever. That can't happen for preferred stockholders. And for common stockholders, there's smaller to no dividend. And also for common stockholders, there's no protection if the underlying company goes bankrupt. Growth, income, and value stocks. So here, before we even get into this slide too much, think back. What were the two ways investors could make money from investing? It was one, selling the stock for a profit, and it was the option two was dividends. So growth stocks are companies that take all their profit and throw it right back into the company for future growth options. Whereas the income stock companies are the companies that are your steady and constant. They have a great predictable business model that give you a modest gains. These are your Walmart companies. This is your Johnson & Johnson companies. This is your 3M companies. All of these companies are companies that pay a regular dividend to shareholders and also have proven themselves as a company to have a stable and predictable business model. Okay, more on the growth stocks. Growth stocks are expected to outperform the overall market. This is in partial because they're taking all of their profit, investing it back in the business for a bunch of future potential. Typically, these stocks, again, have no dividend, and these are your FANG stocks. This is your Facebook, your Amazon, your Netflix, or your Google. And then there's also value stocks. And a value stock is any stock that's thought to be trading below its financial or fair market value. And so any stock can be a value stock. And the money made from value investing is whenever you've done your due diligence, you've looked at all the reports, you've heard interviews from the CEO, and you're just asking yourself, why isn't this higher? Like, I only see good thing after good thing after good thing. And so you purchase a bunch of those shares in that company because you see that it's priced lower than its intrinsic value is. And once enough investors recognize this and buy it, well, then the price will rise to match what this stock is worth, and you will have made your gains from that stock. Okay, what is large, mid, and small cap stocks? So large, mid, and small have to do with the market capitalization of the company. Market capitalization, we'll say this again in the looking to the numbers section, but market capitalization is just the price times the number of shares. That will give you the stock's market cap. And so large cap companies are the $10 billion plus market cap companies. Your mid cap companies is that $2 billion to $10 billion range, and your small cap is the $300 million to $2 billion. Now, more on large, mid, and small. That might seem relatively obvious from just the namesake, but what's the difference between investing in a large cap and investing in a small cap? The main difference is the small cap stocks are thought to be much more risky. That's because they haven't been able to prove themselves over the test of time. If a company's grown to be 10, 50, 100, 500, $1 trillion in market cap, then that company's most likely not going anywhere. But if a company is just starting out on its legs, it's worth $300 million. It's a small company. It's still a business. Well, while you can still invest in these companies, and if one of these companies becomes the next $1 trillion company, you'll make a ton of money. It's just a much bigger risk. Here, I want to share with you this 9-tile style box. This is something you would see if you're ever on Morningstar, checking out a Morningstar report. And this one specifically is for the Invesco QQQ and Trust. Now, the QQQ is an ETF, and we'll talk more about ETFs shortly. But an ETF, more or less, is a basket of stocks. Instead of just one stock, it's a bunch of them. And here, what do we see? We see these bullets in the growth column, and they're above the large row. And so what this is telling us is that the ETF, the basket of stocks that is the QQQ, is composed of companies that are very, very large, and they are growth oriented. So what could those companies be? I know you're seeing the answers right in front of you, but these are mostly our FANG stocks. This is Apple, Microsoft, Amazon, Alphabet, which owns Google, Facebook, and Tesla are the top holdings for the Invesco QQQ. All of these very, very big companies, very, very large, and all of these definitely growth stocks. So here, the 11 stock market sectors. Okay, so before we get into what are the 11 stock market sectors, why is this important? And again, being able to classify what you own is important whenever you're doing your due diligence and wanting to compare it to other stocks. We need to know what these 11 sectors are, because you're not going to be comparing Wells Fargo to Amazon. It's a totally different business model. You're not going to be comparing Tesla to Boeing. Just a different business model altogether. You want to compare like-to-like companies. So going back, our 11 stock market sectors. First the energy sector. This is your oil, gas, and fuel. This is your ExxonMobil and Chevron. You have materials for chemicals and packaging. That's your Sherwin-Williams or DuPont. You have industrials. That's your defense, airlines, and logistics. That's your Boeing and Union Pacific. You have your utilities company. That's your electric, gas, and water companies. That's your Duke or your American Electric Power. You have your healthcare sector. You have your financial sector, which is your banks. You have your consumer discretionary. That's e-commerce and restaurant. You have your consumer staples. That's food, beverage, personal care. That's your Coca-Cola and your Procter & Gamble. You have your information technology sector. That's your internet and semiconductor sector. You have your communication services. That's your service providers like AT&T or your telecom companies. And then another sector is real estate, and that's your REITs. And we'll talk more on REITs in a moment. All right, that means we've made it to the second half of the Digging Deeper section. In this second half, we're going to be talking about our different investment options. Also, if you've made it this far in the video, comment the word rich down below, because that's what you're going to be having learned all of this great material. When you purchase an individual stock, you're buying a share which represents partial ownership of a company. The pros of buying an individual stock is that you know exactly what you own, there's no management fee, and taxes are easy to manage. It's easy to know that you have a capital gains or a capital loss. If you purchase shares of Apple, you know that you own Apple. The cons of purchasing an individual stock is that it's much more risky. It's harder to diversify. You need to monitor your portfolio. And there's high volatility with individual stocks. Next, we have mutual fund. All right, a mutual fund is a company that brings together money from many people and invest it in stocks, bonds, or other assets. The combined holdings of stocks, bonds, or other assets the fund owns are known as its portfolio. Okay, so this is really important, and this is something that mutual funds, index funds, ETFs, and REITs all share. All of them are baskets of other securities. Whereas whenever you're just purchasing an individual stock, if you're just purchasing Apple, then you just own Apple. If you're purchasing a basket, then that means you own many, many things. Now, how does that influence our investment? Well, owning many, many things will de-risk your investment. If you only own a single individual stock, then your whole portfolio depends on that one item. Whereas if you purchase a basket, or which is a mutual fund or an ETF or an index fund, then you are purchasing many, many securities, and that will decrease the amount of risk you're taking on. So that's something really important to understand with all of this. Going back to mutual fund, what are the pros of mutual funds? Well, they're more diverse. There's professional management. There's lots of options, and it's low volatility. The cons of a mutual fund are that there are higher fees, they're not FDIC insured, and they're not traded on an exchange. Index funds. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Index funds have lower expenses and fees than actively managed funds, and index funds follow a passive investment strategy. The pros to investing in an index fund is that they are highly diversified, there's very low risk and very low fees, and actually index funds, specifically the S&P 500, is what Warren Buffett recommends to investors. Some cons of investing in index funds is that they lack downside protection. If the whole market goes down, you better believe that an index fund that tracks the market will also go down. There's no control over your holdings. Again, an index fund is a basket, and what is in that basket can be changing continuously. So you don't have control over your holdings in that respect. Also, another con is that there's no satisfaction from making a good buy. There's just something so sweet about doing your own due diligence and finding a stock that ends up being a slam dunk. And whenever you're investing in a broad market index fund, it just kind of takes the fun out of it. It's still probably the smartest and safest thing you can do. I mean, it is what Warren Buffett recommends, but this lack of satisfaction is something to take into account. Exchange-traded funds, ETFs. An exchange-traded fund is a type of security that tracks an index sector, commodity, or other asset, but which can be purchased or sold on a stock exchange the same way a regular stock can. The pros of investing in an ETF is that they are diversified, there's low expense ratios, and they're easy to own. The cons are that actively managed ETFs have higher expense ratios. They're typically focused on one industry and they're limited downside protection. So we've come to the term expense ratio a few times. What exactly is an expense ratio? Well, for all these baskets, for the mutual funds, the index funds, the ETFs, and a REIT, they are again, it's a basket of securities put together by a team. And so your expense ratio is the payment you pay to a team. And in a high expense ratio, like we just mentioned, an ETF could have, especially like Cathie Wood's ARK has a relatively high expense ratio, and that expense ratio is 75 basis points. That is 0.75%. That means you are paying Cathie Wood and her team 75 cents for every $100 you invest into her fund. Real Estate Investment Trust, or REIT. REITs are companies that own or finance income-producing real estate across a range of property sectors. Some pros of owning REITs is that, for one, it allows anyone to be a real estate investor. You no longer have to have millions of dollars to be a real estate investor. You just need to purchase partial ownership in a REIT. Another pro is that they have stable cash flow through dividends, and also real estate is historically a sound asset class. Some cons of REITs are that, for one, they can have high management fees, and two, REITs must pay 90% of their taxable income back to investors. And why is this a con? Well, this significantly reduces their ability to invest back into properties to raise their value or to purchase new holdings. If REITs are paying 90% of their profits back to investors, then that limits their growth opportunity because they only have 10% of profits to then go back and purchase new properties. So while this 90% payout allows REITs to offer their investors a stable cash flow through dividends, it also stifles the company's growth overall. So just something to consider if you're thinking about purchasing a REIT. Asset classes. An asset class is a grouping of investments that exhibit similar characteristics. Commonly talked about asset classes include equities, which are stocks, fixed income, which is bonds, cash equivalents, or REITs. There's asset classes. Now, we just mentioned asset class in the previous slide, but an asset class is a grouping of investment that exhibits similar characteristics. We have equities, which are stocks, and we have large cap stocks, small cap stocks, emerging market stocks, international stocks. We have fixed income, which is bonds. We have cash equivalents, or just straight up cash. And we also have REITs, or real estate. These are all different asset classes. Here, I wanted to include for you this chart. This is an annual asset class returns from the past 15 years, from 2006 to 2020. I just found this chart super interesting. Now, it is important to note that past performance does not guarantee future returns. However, just looking at this chart, I found it really interesting. At first glance, you see REIT at the top of several of the years. However, if you look in the bottom left-hand corner, you see that REITs returned an annualized return of 7.15%, while large cap stocks took the cake with 9.88% annualized return. So just something interesting here. If you want to look at this chart in more detail, again, I have this full presentation linked down below, so feel free to get it down there. All right, looking to the numbers. I'm a big math guy, so I'm excited for this upcoming section. Let's take a look over at the WEBULL desktop app. Here, this section is going to be focused on all these numbers you see in this top right-hand corner. There's so much information here, and if you just don't know it, you don't know it. So that's what we're going to be learning. If you take a look, you see we have some simple things that you probably could just figure out by guessing, but we have high, open, and low. We have previous close. But then we also have things like P/E TTM. What does that mean? Or what does percent range mean? Or what does EPS mean? These are all things that, again, they're pretty simple, but if you don't know it, you just don't know it. So let's take a dive into the looking to the number section and learn about all these great things. So open, high, and low. Going back over to WEBULL, we see it up here. So the high price is the highest price in which this stock has sold for on today's date. So Tesla, we're looking at the Tesla stock. Its current price is this $786.62, but the high that it has sold for today is $789.10. What did the price open at? Well, it opened at $780. And what was the low for the day? The low for the day has been $776.21. So that's open, high, and low. What is volume? Well, volume measures the number of shares that have traded in the stock on the given day. So if we look here at volume, we see the volume so far has been 4.86 million. Now I am filming, and we just saw it go to 4.87 million. I am filming this in the morning. It's about 9 a.m. my time right now. So as the day progresses, this number will go up. Now we just saw it again, 4.88 million. So this is just the number of shares that have traded hands so far in the given trading day. What is previous close? Well, this represents the price which the stock sold for at market close on the previous day. And I do want to point something out quickly here. Notice that the previous close was $781.31 and the open was $780. So why is there a discrepancy between the previous close and the open? Well, this is because some trading does happen in the after hours. So that's where the discrepancy between the numbers can come from. All right, what is market cap? We talked a little bit about market cap in an earlier section of the video, but if you're skipping around due to the timestamps down below and you just came here, great on you. Market cap is, again, it is price, the stock price times the number of shares outstanding. Market cap refers to the total value of all of the company's shares of stock. Market cap measures what a company is worth on the open market. So here I gave an example. So GameStop has a current share price of $202 with 71.82 million shares outstanding. So what would GameStop's market cap be? We just multiply the two together and you get $14.5 billion. What is average volume of 3 months? 3M stands for 3 months. So going back to WEBULL, we see that our volume, and we see our volume is steadily rising. We see that the Tesla volume for today so far is 4.93 million shares have traded hands, and the average 3-month volume is 18.98 million. So we would expect the volume for the day to approach this 18.98 million number. If it's far lower, if it's later in the day and it's far lower, or if it's far higher, then that tells you that there's a lot of trading happening. And if the volume is exceedingly high, that typically leads to more volatility in the stock. What is percent turnover? Okay, percent turnover measures how often shares change hands. It is a measure of stock liquidity calculated by dividing the total number of shares traded over a period by the average number of shares outstanding for the trading day. So percent turnover, again, is volume divided by the total number of shares times 100%. So going back to WEBULL, what is our percent turnover for Tesla? So it's only at 0.5% right now. It just went up to 0.51%, and this will increase throughout the day, just like the volume is. And why will it increase throughout the day? Well, it's because it's dependent on the volume. It's the volume divided by the shares outstanding times 100%. And the percent turnover is telling you what? It's telling you the percent of shares that have traded hands on the given day. So 0.5% of all of Tesla's shares have traded hands today so far. What is 52-week high and 52-week low? This is another more straightforward one, but respectfully, the 52-week high and the 52-week low tell you the highest and lowest price that stock has sold for in the last year. What is turnover? We just talked about percent turnover. What is turnover? Well, turnover is the value. It refers to the sum of the value of all trades during the trading day. So to find turnover, you'll take the volume and multiply it by the price. What is percent range, or also known as range ratio or range rate? Well, the percent range is a measure of stock volatility. You find it by taking the high and subtracting the low, and then dividing by the previous close and multiplying by 100%. In our example, we see that AMC closed yesterday at a price of $44.38, and today AMC's share price has seen a high of $44.80 and a low of $42.47. So we plug all those numbers in and we get a range rate of 5.25%. So the higher this number is, that tells you the more volatile the stock is. And a lot of day traders like to trade on volatility. So that's where this number is used. Okay, here's that P/E-TTM. What does that stand for? It stands for price per earnings from the trailing 12 months. Okay, the PE ratio is used for valuing companies to find out whether they are overvalued or undervalued. In essence, the PE ratio tells us how much an investor is willing to pay for $1 of a company's earnings. Also, TTM means trailing 12 months. When calculating the PE ratio, TTM, you will use the average earnings per share for the last year. So to calculate price per earnings, you're going to take the share price and then divide by the earnings per share for the last year, for the trailing 12 months. So here in this example, we have Tesla, and it has a current share price of $733.57, and the EPS for Tesla is $1.91. And so you divide these two, and you get that the PE ratio is $384. Let's go back to our WEBULL. So here we can see Tesla today is a little bit higher than when I made this presentation. So we should expect our price per earnings ratio to be a little bit higher, and it is at 409. Now I want you to also see that there's another price per earnings ratio number right over here. Again, this is for the trailing 12 months, so what would this price per earnings ratio for? Also notice that it's significantly lower. This price per earnings for the trailing 12 months is again saying that investors are willing to pay $409 per every $1 of earnings that Tesla has. Now, what is this PE ratio saying? Going back to our slide, This second PE ratio is our forward or expected PE ratio. Okay, and instead of dividing by the earnings per share of the trailing 12 months, we are dividing by our expected earnings for the next 12 months. So here in this example, Tesla has a current share price of again $733.57, and the expected earnings for Tesla over the next year is $4.72, giving Tesla a forward PE ratio of 155. And so we can see, and again going back to WEBULL, we can see that over the next year, it's expected for Tesla to really grow into its earnings, going from investors paying $409 for every $1 of earnings to investors paying $104 or $145 for every $1 of earnings. So that's where you can use these price per earnings ratio numbers. Here we have the PB ratio. The PB ratio is used to compare a company's current market value to its book value, where book value is the value of all assets owned by a company. You find the PB ratio by taking the market cap and dividing by the total stockholders' equity, where total stockholders' equity is simply the balance sheet assets minus the balance sheet liabilities. Here's an example. Bank of America's balance sheet shows a total equity of $251.6 billion with a market cap of $345.4 billion. Therefore, you divide the two and you get the PB ratio is 1.37. So this tells investors that the market is valuing Bank of America at 1.37 times its book value. Typically, value investors look for a PB ratio under 1. However, under 3 is often used as a good benchmark. Price to sale ratio. The PS ratio or price to sale ratio shows how much investors are willing to pay per dollar of sales for a stock. A low ratio could imply that the stock is undervalued, while a high ratio or a higher than average ratio could indicate that the stock is overvalued. You find the PS ratio by taking the last price and divided by the revenue per share. So here in an example I created for you guys, Company X has 100 million outstanding shares trading at $10 per share. In the last 12 months, Company X has $455 million in revenue. So the revenue per share would be the total revenue divided by the total number of shares, taking you to the $4.55 revenue per share mark. And then for the PS ratio, you would take the last price, the last trading price, which is $10, and divide it by that revenue per share value of $4.55 to get a price per sale ratio of $2.20. Earnings per share. All right, what is earnings per share? We've talked about it a little bit for the PE ratios, but earnings per share specifically is the portion of a company's profit allocated to each outstanding share of common stock and is calculated by dividing a company's diluted profit or earnings by the diluted weighted average of outstanding shares. So you just take the company's profit, divide by the total number of shares, and that is your earnings per share. What is a dividend? Okay, again, we've talked about dividends several times. A dividend is, again, one of two ways for you to make money in the stock market. And a dividend is a distribution of profits by corporations to its shareholders. When a corporation earns a profit or surplus, it is able to pay a proportion of the profit as a dividend to shareholders. Any amount not distributed is taken to be reinvested into the business. So here in this example, we see Johnson & Johnson pays a dividend on a quarterly basis, and their most recent dividend was $1.06 per share. Therefore, J&J's annual dividend is the calculation of the most recent dividend multiplied by 4. Since their most recent dividend was $1.06, we multiply that by 4, and we get that Johnson & Johnson pays a dividend of $4.24 per share annually. All right, Div Yield. This is Dividend Yield. And let's go back over to WEBULL for a moment. So looking at Tesla, we see that Tesla has a dividend yield of 0.00. This is because Tesla is a growth stock and does not offer dividends. Let's move over to Johnson & Johnson. And we can see here they're slipping today, but Johnson & Johnson has a dividend yield of 2.58%. They offer a dividend of $4.24. Okay, so what is the dividend yield? Going back to our presentation, dividend yield measures how much a company pays out in dividends each year relative to its share price. So, going back to WEBULL, what you do is you take your dividend, which is an annual $4.24, and you divide it by your share price and then multiply that by 100%. So, one share of Johnson & Johnson today is this $164.20. 2.58% of this price is $4.24. Therefore, for every share of Johnson & Johnson you own, they are paying you 2.58%. And that's better than a bank account, my friends. All right, that's what dividend yield is. What is shares outstanding? We've mentioned shares outstanding and calculating some other of these financial ratios, but shares outstanding is simply all the shares of a corporation that have been authorized, issued, and purchased by investors and are held by them. They are distinguished from treasury shares, which are shares held by the corporation itself, thus representing no exercisable rights. So shares is just the total number of shares that have been purchased by investors. What is next earnings? Well, next earnings, this is a date which represents the company's upcoming earnings call. An earnings call is a teleconference or webcast in which a public company discusses the financial results of a reporting period. Going back to WEBULL, just so you can see, Johnson & Johnson's next earnings call is for October 19th, 2021. So it's coming up. On this date, Johnson & Johnson will have an earnings call, and they'll discuss their financials for this previous quarter and for the upcoming quarter. And if they're on track, or if they're doing poorly, or if they're doing well, the stock price will shift accordingly to their earnings call. Constructing your portfolio. This is the section where everything we've learned comes together. Let's dive into it. Firstly, what even is a portfolio? A portfolio is simply the collection of your financial investments. When you're constructing your portfolio, you want to think about what percent of your money you want within each asset class. How much money you want in stocks, how much money you want in bonds, how much money you want in real estate, how much money you want in crypto. And this distribution of your money is asset allocation. Asset allocation is the implementation of an investment strategy that attempts to balance risk versus reward by adjusting the percentage of each asset in an investment portfolio according to the investor's risk tolerance, goals, and investment time frame. Whenever you're constructing your portfolio, you do definitely want to think about and identify your goals and identify a time frame for these goals. Some common goals investors have are buying a home, having kids, saving for retirement, getting married, a career change, starting a business. All of these goals or more are perfectly great and valid. Whenever you pick your investing goal, keep your time frame in mind. As you approach your investment goal, it's important to de-risk in case there is a sudden downturn in the market. All right, this is very important. As your investment horizon, your investment goal gets nearer and nearer, you want to de-risk. And why is that? Well, if you're saving for retirement and you have several decades to save and there's a downturn in the market it's not that big of a deal because you have many decades to continue to grow and build your wealth. However, if you're 65 and fixing to retire, you want to be invested such that you have much less risk, because if you're just as risky in your investments at 65 as you are at 20, then whenever you're fixing to retire and there's a sudden market downturn, you don't want your portfolio to lose a hefty part of its value because you don't have the time to build it back up. So whenever your investment goals are getting nearer to their time horizon, it's important to de-risk. Okay, assessing your own risk tolerance. This is also important. You really need to know yourself here. Ask yourself these questions. Are you looking to build wealth or preserve wealth? If you lost this money, would it affect your daily life? What are the time horizons and goals for your investment? Okay, understand that equities and crypto are seen as higher risk investments, while fixed income is seen as a safer option if you're looking to preserve wealth. This is, again, really important. If you just have a little bit of money, like let's say $100, you might be fine with putting it in something really risky. And if that happens to not work out and happens to go to zero, well, that's really unfortunate. But hey, it's only $100. If you have saved for years and years and have $10,000, $20,000, and you're wanting to start investing, taking all of that money and putting it into something really risky and then it going to zero is going to hurt a lot. So really assess and know your personal risk tolerance and invest accordingly. Here we'll talk about concentrated versus diversified portfolios. We've mentioned this a little bit whenever we were talking about investing in an individual stock versus a basket like an ETF. You know, a concentrated portfolio would have fewer holdings, and with fewer holdings, you have an increased risk, but you also have increase for potential returns. Whereas a more diversified portfolio has many holdings and it's less risky. However, you have limited potential gains. Let's talk about some different investment strategies, such as lump sum versus dollar cost average investing. All right, these investment strategies are just as they sound. Lump sum investing is whenever you take all of your cash on hand and dump it into the market all at once. Dollar cost average investing is whenever you look at how much cash you have on hand. Let's say you have $10,000, but you don't want to just lump sum it all into the market. What's another option? Well, you can invest $100 every week for the next 100 weeks, and that would be a dollar cost average strategy. I will say that lump sum investing over the course of time has outperformed dollar cost average investing 2/3 of the time. And this is where the saying, it's about time in the market, not timing the market, comes from. I will also say lump sum investing isn't a super realistic strategy. Now, what do I mean by this? Well, if you're just starting out, maybe it is a realistic strategy in that you have a bunch of cash on the side. However, if you already begin investing, you can really only lump sum one time. After that, you can't really invest until you get paid. And us as people are paid by our jobs bi-weekly or monthly or maybe weekly. So if you have a strategy of taking a portion of your paycheck every time you get paid and putting that into the market, then that's a dollar cost average strategy. And if you have a job that offers a 401k retirement plan, you're already using this strategy. Also, for dollar cost average investing, I will say it's easier on the psyche, meaning that if you take a lump sum and you're on the unfortunate side of the 2/3 of the time where it's better, if you're on the unfortunate side where you just put your lump sum in and there's a big market downturn immediately, that's going to sting a little bit. So if you just stick with the dollar cost average plan, you put your $100 in and then there's a market downturn, Well, then the next week when you put $100 in, you're getting it at a better buy, and it's just easier on the psyche this way. Understanding market psychology. Speaking of being easier on the psyche, market psychology is very, very important. Letting emotions govern investment behavior often leads to irrational decision making that can cost you dearly. You don't want to FOMO in and you don't want to panic sell. It's usually best to ignore the trend of the moment, whether bullish or bearish, and stick to a long-term plan based on sound fundamentals. It's also critical to understand how risk sensitive you are and to set your asset allocation accordingly when fear and greed grip the market. It's important to understand the influence of fear and greed. Fear and greed create overreactions. Fear leads to markets being oversold, and greed leads to assets being overbought. Do your best to adopt a contrarian strategy and buy when others are panicking and sell when euphoria leads to bubbles. Now, that's much easier said than done. It's just in human nature to buy whenever there's euphoria and sell whenever you're panicking. It's very hard to do the opposite. However, great ways to overcome fear and greed is to just stick to the fundamentals of investing. Stick to your dollar cost average strategy, maintain that long time horizon, and ignore the herd, ignore the trend of the moment. These are all great ways to overcome fear and greed. Some behavioral biases and how to avoid them. Some behavioral biases include overconfidence, regret, limited attention span, and chasing trends. And really the best way to avoid these biases is to trade less and invest more. Invest in assets that you believe in for the long term. Don't try to be a day trader. Don't try to beat the market. Try to invest and invest regularly. Have a dollar cost average strategy and keep that long time horizon. Trade less and invest more. Okay. Now that we've talked about some market psychology, it's time to buy your very first stock. This is exciting. Let's head over to WEBULL, see how to do it. So what stock are we going to buy? Well, what stock am I going to buy? You can buy whatever you want. So if you're unsure what to buy, I definitely recommend to do your own research or to look into the SPY. This is the ETF that follows the S&P 500 market index. This is what Warren Buffett recommends. I already own some shares of this, so I'm actually going to buy a share of Palantir today. Palantir is a company I like, and it's having a down day today. So this is what I'm going to buy. And the way to purchase is you click on order entry. We need to unlock trading, and I'll have to put in my code. All right. Now I want to create a new order. And to purchase, I'm going to say what my quantity is. I'm just going to buy one share. And for order options, there's several. There's limit order, market order, stop limit order, and trailing stop. And 99 times out of 100, you're just going to be using the limit order or the market order. Here, if we go back over to the presentation, I have these definitions for you. A limit order is the highest price you are willing to pay for the stock. A market order simply purchases the stock at the given market price at that exact moment. So if the market price is a little bit higher than you want, you can put in a limit order, and if the market falls down, then your buy order will execute and you'll be able to get the stock for what you want to pay. However, if the stock just doesn't ever go down, then your order won't execute and you won't have bought anything. A stop order activates a market order once the given price has been met. A stop limit order is used to activate a limit order to buy or sell a security once a specific stop price has been met. And a trailing stop order is an order type designed to lock in profits or limit losses as a trade moves favorably. So again, 99% of the time, we're just going to be using limit orders or market orders. Here, I'm just going to use a market order. I'm just going to buy it at market price. And I have my buy option for 1 share at market price. I'm just going to hit place order. I'm going to hit buy and submit it successfully. All right, excellent. That was buying your first stock. Congratulations, guys. It's that simple. Okay, onward. Before we end this presentation, I want to offer you up some of the best advice I can give whenever it comes to investing. First piece of advice I want to give is to know what you own and why. You see, the world is full of hot tips and get-rich-quick advice. And the thing is, even if you follow the 1 out of 100 of these pieces of advice that happen to be right, if you don't understand what the company does, or if you don't understand what can make it succeed or fail, then really your only way to act is based off of stock price. And what's going to happen whenever that price begins to fall? Well, most likely you'll end up panic selling. See, the exact same investment can be one investor's best and another's worse. And the sole distinction between the two is that one investor has done their due diligence while the other hasn't. See, if you're able to answer the question, know what you own and why, that means you will have done your due diligence. That means when things get tough in turbulent markets, when things become extra volatile, if the company you really believe in begins to fall downward, you won't panic sell. You'll actually likely buy more and dollar cost average your position to a lower basis. You see, the most important thing is you being comfortable and happy with where you have your money. Answer this and you will have done your due diligence. A second piece of advice I want to share is to trust yourself, play big, and don't waste opportunity. Great investment opportunities don't come around every day. So if you spot an idea you believe in and have high conviction in, play big. That way the investment can change your life. I first heard this advice from Warren Buffett as he was giving an interview. He suggested a thought experiment of imagining that whenever you turned 18, you were given a punch card with 20 punches on it. And each punch represented a financial decision for your lifetime. He said that you would become very wealthy because you would think very hard about each financial decision you made. He said you likely wouldn't even use all 20 punches and that that's okay because you would have waited for the good and big opportunities and you will have played big and those investments will have changed your life. All right, that's my advice for you guys. Thank you so much for viewing this video, for viewing this full course. I truly, truly appreciate it. Thank you for making it to the very end. As a friendly reminder, I do have this full presentation down below in the description. So if you want to take a closer look at it there, you're welcome to. Also down below, I do have those timestamps in case you want to go back and rewatch any of the portions. And also, I do have linked down below a link to the WEBULL desktop app in case you are wanting to download that and begin your trading. Again, guys, thank you so much for joining me. I truly, truly appreciate it. It means the world to me. You guys are the best. If you could do me a huge favor and share this video with a friend, especially if you found it useful. And also, if you found this video helpful, please hit that subscribe button. It truly means a lot. Until next time, I'm Griffin. Peace and love.